Hello and welcome to ChooseFI. Today on the show, we have one of our all-time favorite guests, Brian Feroldi, back to join us to talk about all things stocks, specifically the stock market, what an investing outlook is for 2024, and how him and I are thinking about the economy, the macro landscape, prognosticators in the media, and all these good things. I think you're really going to enjoy this. With that, welcome to ChooseFI. Brian, my friend, welcome back to ChooseFI. It's always a pleasure to have you here.
Brad, it is always a pleasure to be here. Thank you for inviting me back again.
Yeah, you bet, my friend. So yeah, you are the most frequent guest in the history of ChooseFI. So it's keep the streak going here. I like it. All right, we are recording this on January 23rd, 2024, and we essentially have just hit all-time market highs. Now, this is very interesting in a lot of levels. Obviously, most of us are doing, if you're looking at the market, if you've logged in to your investments anytime recently, and obviously I would suggest to everybody out there, please track your net worth, right? You should be doing this at minimum yearly, which would mean you've done it in the last 3 weeks, but I like to do it quarterly, maybe every 6 months, whatever. So you've probably logged in recently and done some cartwheels or backflips, and it's only continued to go up since then. And Brian, it's been a wild ride, right? Because I think there's such an interesting dichotomy in the sense that the stock market's flying high, unemployment is incredibly low, but yet people have been predicting recession and doom and gloom and horrible, the sky is falling for as long as I can remember. Certainly the last 12 months, 24 months, you fill in the blank, I guess, depending on what corners of the internet or the news you're following. So I'm going to throw it over to you. Like, where are you with this market, with stocks generally? Like, what is your general sentiment?
Yeah, well, if the last few years have reinforced anything for me, is you should take any prophecy or any prediction about what the stock market is about to do with an enormous grain of salt. In 2020, just to quickly recap, we had COVID, we had the fastest and steepest bear market in US stock market history, followed by the strongest and fastest rebound in US stock market history. And then came 2021 when everything worked, everything went up. In fact, the riskier the thing, the faster it went up, followed by 2022 when the exact opposite of that happened. We saw the fastest rise in interest rates ever, followed by essentially the unwinding of everything that worked in 2021. Growth stocks got crushed in 2022. Cryptocurrencies got crushed. And it was a kind of return to sanity, if you will. And at the start of 2023, every economist, without exception, essentially was forecasting a recession over the next 12 months. I mean, how many times did you hear the word recession in 2023? It seemed like it was a guaranteed thing to happen. And what actually happened? No recession. We haven't had a recession yet. And at the start of 2024, our markets rebounded throughout 2023. And as you just pointed out, markets at the time of this recording are currently effectively at all-time highs. So what was the appropriate thing to do over this entire crazy 3-year period? Buy and hold, period.
Yeah, buy and hold, or as our friend Nick Majuli would say, just keep buying, right? I mean, that is the strategy that we've espoused here in the FI community for forever. And in your corners of investing, this is the strategy as far as I can say. I mean, unless some amazing thing comes across my plate in the rest of my lifetime that I cannot envision right now, it simply is that. It's buy excellent companies. It's buy a broad swath of the market, in my case, and hold those for a significant period of time. I think what I've seen is, in my own experience, and certainly you hear stories, it's like, it's funny, actually, I just saw somebody on a FI group ask about, how do you get into day trading? And I'm like, oh no, like run as far and as fast as you possibly can from that. Like that is akin to gambling. And I think that's why, Brian, a lot of people think short term when it comes to the stock market. You always hear like those phrases, right? I'm going to play the market. And I got a hot tip, right? It's like as if like, oh, I found out somebody on the Baltimore Ravens was hurt before the big game or something. Like that's what I think of when I think of a tip, as opposed to buying broad swaths of the economy and keep on buying for years and decades. I mean, to me, that's the secret to success ultimately.
Yeah, and I completely sympathize actually with that person that logged into ChooseFI and said, "How do you day trade?" Because when I first started understanding and learning about the stock market, that was absolutely my mentality. The stock market to me just looked like a random number generator. Up, down, up, down, up, down. And if you don't understand what the market is, how the stock market works, it's so natural to look at it as a giant gambling machine. And if that is the mentality that you have because you are effectively uneducated about what the stock market is, it makes complete sense to want to learn how to play the market, to game the market, and to learn how to make money in the short term. That's a very natural progression and that I personally followed essentially to the T. So if I was just getting started over the last couple of years, I guarantee you I would have been on the Reddit discussion boards. I would have been trading Dogecoin. I would have been all over GameStop. I would have been trying to figure out AMC. So all these mistakes that we see beginners making, they look silly to us because we've been doing this for so long. But if you are just starting out, it's completely natural to want to go in that direction.
Yeah. Yeah, that's a very, very good point. Do you have a back of the envelope heuristic, let's say, for people who are getting started? And this is a weird question, Brian, but bear with me here. So I have in the back of my mind that if I see an investment or I see people talking about an investment that's getting over X percent, that I immediately like the alarm bells start going off for, oh, that can't possibly be real. And I think, you talk about 2021, right? Everything went up. The people in the crypto world, NFTs, things were going, people were expecting them to double in months or even a year. Whereas I think for me, my back of the envelope is 8 to 10% annually. If it's within that realm, 7 to 10%, I'm like, okay, that could be reasonable. Now, obviously, you can also start veering into Bernie Madoff style world where it's a guaranteed return. And I think his was 12%. So alarm bells is ultimately my question to you. Because I think, like you said, you would have gotten caught up in this day trading, in GameStop, et cetera. And I think a lot of smart, good-natured people do as well, just because they don't have the knowledge that you have. Do you have any like quick back of the envelope alarm bells that you would pass along just to a friend or to the son or daughter of your neighbor?
Absolutely. My heuristic is if my mom is asking me questions about the stock market, it's time to get out. My mom, at the peak of the GameStop craze, sent me a text messaging saying, "What is going on with GameStop?" And I was like, "Wow, this has reached you? This
Oh
you
my
could
god.
care less about the stock market. You don't care about this stuff at all." So if my mother is interested or asking questions about the stock market, that is the only bell that I have that
Oh
says
my
this
god.
is the top.
Sell everything. Mrs. Feroldi is
Yeah.
buying.
In generally speaking, if you see people on Twitter or people in your life that you know have no interest in the stock market at all, no interest in investing at all, and they are asking you questions about what you think about it, I take that as a huge contra indicator and a huge warning sign, not a huge opportunity sign. So, yeah, for me, it's my mom.
Okay, I like it. So now the other side, from the maybe the least knowledgeable people to the supposedly most knowledgeable people, right? And I use supposedly very like dripping with sarcasm here because macro. I think a lot of people get caught up in like what's going on in the macro, and like you said, everyone in 2023 was talking about recession. You must have heard it thousands of times in the media, et cetera, and Twitter, and I think it's one of these things where, I mean, I don't know about you, but I think there's probably at most a handful of people on earth who actually understand the macro economy and can predict anything. It might be far fewer than a handful of people, but yet there's some allure to these seemingly smart people, these seemingly knowledgeable people, but yet people get it wrong all the time. I wonder how you consider the macro economy in terms of all these people prognosticating. I know, again, this is a circuitous question, but it's more just like a felt sense that you have. When you hear people talking about, oh, because interest rates are going up or down, it by definition is going to have this effect on the economy or the stock market. Oh, there's a guaranteed recession coming in the next 12 months. Like, again, going back to your alarm bells for your mom, do you have similar alarm bells, I guess, either to the good or bad when you start hearing people talking about macroeconomic takes?
When it comes to macroeconomics, what I've learned is that if you're talking to a smart person, they can convince you of anything is about to happen by using macro data. Two smart people could literally show you macro data and make you convinced that the dollar's going to zero, this is the top, it's all over for the United States. Or that same person, if they showed you macro data, could make it seem like the United States is the best place to invest. Right now is the time to get in. We're set up for the next huge bull run. So I have just been listening or aware, I guess, of that macro talk for now 20 years. And that experience has taught me more than anything to just tune it out. And whenever you look back at history and someone gets credit for calling the 2008 financial crisis or calling COVID, it just means that that person was a perma bear that was accidentally right.
Right.
That is what I've learned from people that make macro calls. And
Right.
my favorite macro, I put this in enormous air quotes, macro forecaster is David Gardner. He's one of the co-founders of the Motley Fool. And for those that have no idea what I mean, when he's asked what he expects the market to do in any given year, his answer is up.
Okay.
That's it. And he is right 70% of the time because the market goes up about 70% of the time in any given year. So he has no thought process behind it. He has no research to back it up. He just says, well, the market goes up about 2 out of every 3 years. What's it going to do this year? It's going to go up. And he is perfectly comfortable with being wrong 1/3 of the time. So if anybody asks me what the market's going to do this year, that's my response. I think it's going to go up.
Yeah, Brian, I love that. And obviously, David is we both know him and he's a brilliant guy, but that's like a funny take on, hey, just thinking in bets, right? 70% chance it's going to go up based on historical data. All right. Yeah. What do I think is going to happen? It's going to go up. That's awesome. And yeah, I guess for me, going back to the macro, you can tell you've got your air quotes. I've got my dripping sarcasm. Like, I think anybody who has some macro take and thinks they're brilliant, like it's usually some apocalyptic thing. Like it almost invariably I find is a negative take. And it goes back to like loosely paraphrasing. I think it's Morgan Housel is being pessimistic. You sound really smart, but being optimistic is what makes you actually wealthy. And I think it's so easy to get sucked down the apocalyptic route. And I've noticed this even with well-meaning people, and not to call anybody out certainly, but the guy Tom Bilyeu, who I've followed for years on his podcast Impact Theory, and he just of late, of the last 6 to 12 months, I've just noticed like a dozen of these apocalyptic macro guests, and I'm like, oh man, you just fell down the wrong rabbit hole. In essence, like you don't really have any knowledge, but you got sucked down, and it's sad, like you said, you can be convinced. You really can. It's pretty easy. But also, to your brilliant point, you could be convinced of the opposite, just depending on how somebody wants to massage the data. So I think the long story short is I would just stay away from that kind of stuff. It just, it very rarely has any inkling of what actually comes to pass. And again, like you said, that one person who picked the X recession, well, they probably called 59 of the last 2 recessions, right? So they just happened to get that one exactly right at exactly the right time.
Yeah. So the very first book that I read that turned me on to the whole concept of money and investing was Rich Dad Poor Dad by Robert Kiyosaki.
I
And
saw this one coming from a mile away.
and that I owe that book so much because it was the first book I read that gave me a true education that was rich people think differently than the middle class. Rich people own assets. You can become rich in one generation. All these things that we take for granted now, but they were revolutionary ideas the first time I read them. But Robert Kiyosaki, who again wrote that book, it's one of the best-selling books ever in the money and personal finance space. He's been calling for the essentially end of the United States for the last like 15 years, ever since the recession of 2008. And there's this wonderful tweet that somebody put together of him calling that this is the top over the last 15 years. And every time he did it, the market just did nothing but go up from there. So when you see people that are just constant doomsayers, what that tells you is that they're really good at getting attention and that their track record with calling the market, it doesn't matter because what matters is they sound smart and they sound like they're trying to help you.
Yeah. Yeah. And right, it's hard to know sometimes. Also, people's motivations, their incentives, right? For him, has he just gone off the deep end? It's very, very possible. Is he just looking for more eyeballs and clicks? That's also possible too. Could it be some combination of the two? Yeah, of course. It's impossible to know. But yeah, you have to be careful who you listen to. I think this is just a really important part of life and media in the modern age. It really is. And Brian, that all said, so we've been kind of poo-pooing the macro, and understandably so. But the intelligent listener would say, okay, guys, well, look, things also are happening, right? I mean, Brian, we've seen interest rates, as you said, 2022, the fastest rise in interest rates ever. And they seemingly have kind of stabilized, come down a little bit, certainly on mortgage interest rate. But we've also seen, for the first time since I graduated college, we've seen really attractive interest rates for savers, right? High yield savings accounts now are paying 5% or more, which is actually really cool. So there has been an impact, obviously. And I'm curious how you think about, I guess, let's start with interest rates, both to the good and bad. How are you thinking through the impact of interest rates on the economy, the stock market, your personal finances, however you want to take that?
Well, what's been so interesting is that I've been investing for 20 years now. And effectively, from 2008 until the start of 2022, interest rates during that time were essentially zero, like zero. So during that period, money was extremely cheap. So a ton of capital was forced because of those low interest rates into the stock market, into venture capital funds, and after risky, long dated assets. And during that entire time, the thing to do was to invest in the stock market. It was a wonderful time to be a stock market investor. When I was thinking about asset allocation during that time, I said to myself, investing in bonds makes 0 cents, like 0 cents. I'm getting paid no interest at all. And if interest rates ever rise, the value of those bonds are destined to fall. That's how bonds work. Bond prices move in the inverse relation to interest rates. So interest rates go up, bond prices go down. So for effectively the majority of my investing career, I've given zero thought to investing in bonds. Zero. They've made absolutely no sense. Now that interest rates have actually risen for the first time ever, I'm actually thinking, does adding bonds to my portfolio actually make sense? And I have a private investing community. We invited actually Frank Vasquez on to give us a re-lecture on bonds, because when he was on the ChooseFI podcast, couple hundred episodes ago at this point. It was a wonderful, wonderful talk that he gave about the different types of bonds and how to think about bonds. So I still don't own any bonds, but I am holding more cash than ever, because to your point, the interest rate on cash is now, 4 or 5%. And I'm giving serious consideration to adding at least a little bit of bonds to my portfolio because interest rates finally make sense again.
Yeah, Brian, that episode with Frank was episode 194. It was entitled The Role of Bonds in a Portfolio. And yeah, Frank is just an extraordinary member of the ChooseFI community. He's probably the single most active person in our Facebook group. And he has a marvelous podcast called Risk Parity Radio that I would suggest you and everybody else listen to. It's really, he's something special. So yeah, I'm glad you brought that up. So investing in bonds, I definitely want to talk about high yield savings and what we're doing. But okay, so you're thinking about investing in bonds. What would that look like? And I'm not sure if you have invested in bonds or if it's just the first time you are thinking about it. But if you were to do that based on how you construct your portfolio, how would you move forward from there? Like, first off, what type of bonds, or would you buy bond funds? And what type of allocation would you be considering?
Yeah, so my first thought is to just buy a total market bond index fund. I realize that when you say a total market fund, it operates differently than a total stock market fund, but effectively you're buying thousands of bonds in one go and you're getting the combined interest rate. That would be my first hunch. And to answer your question, I do not own any bonds as of yet. But after re-listening to that episode with Frank, I do know that one of the first things you have to ask when you're investing in bonds is, well, what do you want from the bonds? What's your goal with the bonds? Do you want income? Do you want diversification? Or I think one of the things Frank said was, do you want to own a non-correlated asset to your stocks? A non-correlated asset in both directions. So if your stocks go up, this will go down, and vice versa. But analyzing bonds is something that I I have no interest in doing. So I would probably stick to just broad based total bond funds. Or if I wanted to get more tactical, buying some exchange traded funds that focus on a specific type of bond. But again, bonds are a brand new world to me, something I've never invested before. So I like to keep things super simple at the start and then only add complexity later if I feel it's necessary.
Okay. Okay. That makes sense. And yeah, we obviously do not give investment advice here at ChooseFI, but Vanguard's total bond market ETF, just for instance, as a starting point for anybody, is ticker symbol BND. So that's something to consider, or at least as a starting point for your research. So, all right, that's very interesting, Brian. So now again, the other area we've seen this high yield savings accounts, and I think there is some obvious allure to a 5% interest rate that's guaranteed. But also, it's interesting that if people had stuck all their money in there, like part of me says, from looking almost at like the 4% rule, Brian, and I know this is kind of silly, but like, oh, wow, I can get 5% guaranteed right now in a high yield savings account. What if I had my entire net worth in there? Well, my 4% rule all of a sudden turns into 5% rule. Now, of course, it's not that simple. And there's no world where I could move my entire net worth into that. But I think that line of reasoning suggests that there are people who are like, oh, wow, that's pretty nice. I wouldn't mind getting a guaranteed 5% return. But clearly, there's opportunity costs, right? What are you giving up? And just looking at the returns in the stock market from 2023 of double digits or more, okay, what would I have given up? So I guess, how do you consider if somebody came to you and said, hey, Brian, this 5% is too good to pass up? How do you describe that concept of opportunity cost? How do you describe how somebody should actually think through that? Because it's much more nuanced than just guaranteed 5%.
Yeah, opportunity cost is a real thing, but it's a theoretical cost. Whereas if you put money into a savings account that has a 5% guaranteed interest rate, that is a real return that you earn on a quote unquote guaranteed basis that just gets automatically put into your account. That's super attractive. There are a couple things that I would push back against that though. Savings account, the returns you get on savings account has risen dramatically over the last year because interest rates have risen dramatically. Well, what if interest rates fall in the near term future? Well, then the interest that you're getting on that money you're keeping in a savings account will fall in lockstep. The forecast that I've read, and again, we get back to forecasts again, is that interest rates are projected to fall over the next 12 months. The pace of how much they're going to fall and the rate is obviously going to vary on a huge number of factors, but it wouldn't surprise me now that inflation has come down significantly from where it was in 2022, if the federal funds rate dropped by a few basis points, and then your savings account would also drop by a similar amount. So just know if you're putting money into a savings account, the amount of interest that you get is going to be variable with the general prevailing interest rates of the day. If you're interested in locking in that 5%, then you could think about putting it into a CD or some kind of asset that pays you a more guaranteed rate or even a bond fund. But by doing so, then there are also opportunity costs, of course. But what if interest rates increase? What if inflation comes back? Then the purchasing power of the money that you're earning will, of course, be eroded by that inflation. And you might be missing out on a higher interest rate based on what happened with prevailing rates. So I'm with you. My broker, I use Interactive Brokers. Just keeping cash in my brokerage account is currently paying me 4.8% for effectively doing nothing, which is very, very attractive to me to just hold cash. But just know that those rates in savings account, in brokerage account, they're variable for one. And to your point, you are missing out on an opportunity cost for keeping them in higher earning assets. So like always, Brad, the first thing to do before you make any capital allocation decision is to ask yourself, when do I need this money? If the answer is 10 plus years from now, then I would argue the best place to keep that would be in something like the stock market or in real estate, if that's your investing jam. If it's a shorter period than that, then just keep it in liquid assets. And if it's in a medium term, perhaps consider bonds. So what you allocate has more to do with when you need the money than purely tactical, I want to earn a guaranteed rate of return.
Yeah. What's that line of delineation? And now, obviously, we're speaking to a whole lot of people, but again, pretend you're talking to your neighbor who's thinking about buying a house X number of years from now. Is there a line of delineation between, like you just said, if you're thinking 10 years or more, all right, in all likelihood, you're going to advise that person the stock market. If it's under a certain period of time, people are always looking for the prescription. If somebody's looking to buy a house 3 years from now and they're trying to figure out what to do with their down payment money, again, not financial advice to anybody, but what's your back of the envelope sense of if it's 3 years or under and you can get it right now, and obviously we can't know what the interest rates are going to be 6 months from now or 24 months from now, would you consider high yield savings for that? Like, at what point is that line of delineation between, hey, you probably should invest in the market or you should think more short term?
Yeah, so this is when history can be a useful guide. So I have a table actually in front of me right now that shows the historic odds of earning a positive real return, real meaning after accounting for the effects of inflation, in the S&P 500 by holding period. If you buy and hold the S&P 500 for a year, historically, you have made money in real terms 68% of the time. If you bump that up to 5 years, you've now made a real rate of return 80% of the time. If you bump that up to 10 years, you're up to 88% of the time. And if you bump that to 20 years, you're up to 100% of the time. So if you're putting a line in the sand, you're always still accepting some level of timing risk. So unless you say 20 years or more, you're accepting some level of market risk. For me, I'm comfortable with saying 5 years, knowing that still 20% of the time, 20% of the time over a 5 year period, you still lose money in absolute terms by investing in the market. But to me, that's a decent enough line to draw a line in the sand. And if you're more conservative, go 10 years and just know that 1 out of 10 times you'll be losing money in real terms. But yeah, for me, a decent enough rule of thumb is 5 years or more. That's money that is a good candidate for allocation to the stock market.
Yeah, good candidate's the perfect way of putting it. And yeah, every person's going to be different, but yeah, I like that. And I like also how that stat ties with David Gardner, who we mentioned before, right? You said the S&P 500 on a 1 year period, 68%. So that's yeah, that's pretty darn close. I like that. All right, so let's talk about what we're doing. So 2024, I think people are interested, right? Just in, hey, what are Brad and Brian doing with their own personal finances? What are they doing with their investments? Has anything changed? Where are you in terms of, has your portfolio changed in any meaningful way? Where is new money going? What are you thinking about moving forward?
So 2023 was a very profitable year for me. My portfolio returned 40% overall, which sounds great until you realize that that was after the bludgeoning I took in 2022 when my portfolio fell 49%. So I'm still not back to the absolute bubble peaks, but it was a good recovery. But despite the fact that I think I'm known for buying individual stocks, I am not a very active investor at all. I make a handful of trades each year, buying a handful of new positions and selling a handful of new positions that I think that I no longer have faith are going to work out. So 2023 was a year of very low activity for me. And this is when it gets into being the benefit of the stock market. The number one thing I did to improve my wealth in 2023 was nothing. I didn't sell, and that was the most profitable thing that I did all year long. So my personal investing philosophy is I think of my personal finances and my investing finances as two different buckets. And I basically view them with completely different mindsets. My personal finances are hyper conservative, zero debt, paid off house, 6+ months of emergency fund in just cash, earning whatever the interest rates are of the time. So that is my personal finances, extremely conservative. My investments are effectively 100% stocks and 0% bonds at this point, and they have been for years because I don't need that money to pay for my personal life. I use the income from my business and the income from my assets to pay for my life. My wife and I are both still working. So that is the way that I have structured my portfolio. And what do I plan on doing in 2024? More of that. Effectively keep running the playbook that I have, knowing full well that we might be at a market peak right now. 2024 might be a great year for the markets. I have no clue what's going to happen next. But I am fairly confident that 10 years from now and 20 years from now, the markets will continue to hit new all-time highs. And I believe that keeping the majority of my wealth in the stock market is the best way for me to continue to compound my wealth.
Sounds about right. So when you said 100% stocks, that includes certainly a significant amount of index funds. You're lumping that all together, right? Just for clarity.
Absolutely. Yes. So all of my retirement accounts, so IRAs, 401ks, Roths, those are all just index funds purely for simplicity. And then all of my personal and my taxable accounts, all of that is in individual stocks.
Gotcha. Okay. I know we've had people like Carl Jensen, Mr. 1500, come on and talk about this as well, where for him, I don't think it's as much a sense of like your investing checklist that you've talked about in the past and how you are constantly readdressing it. I think when he's considering selling some of his high flying tech stocks, and it's certainly not just Tesla, it's more just a sense of not that I got lucky necessarily, but okay, this obviously worked out better than the average stock market return. I feel like I'm to the good on this. I'd like to consider liquidating some of this position and maybe buying some more total stock market or S&P 500 index fund type thing. So I think that might be different than your more rigorous analysis of the checklist, and maybe you can give a high level overview, or we can reference the episode where you talked about that on ChooseFI. But I guess my succinct question to you is, do you consider ever selling just based on, hey, this has worked out way better than I could have ever imagined? Like, I'm so far to the good, maybe I should consider paring back some of this? Or is it purely, okay, if the thesis still holds, then I'm going to keep on rock and rolling with X, with Tesla or whatever the company is?
Yeah. Selling in general, I find to be many multiples harder than buying. Buying is a pretty binary decision. Does it meet my criteria? Does it not? Am I interested in this company? Is it not? Do I think this company can go up, or does it not? When it comes to selling, that is a much harder thing to do because you're selling based on information that you had. Either you've bought the stock and it's made you money, in which case it's up, or you've bought a stock and it's lost you money. And in both cases, it can be really tempting to sell your winners and buy more of your losers, because if you like the stock at 10 and now that stock's at 5, well, isn't that cheaper? Peter Lynch calls that very thing, selling your winners and buying more of your losers, cutting your flowers and watering your weeds. And
Okay.
with so many things about proper investing, what your natural inclination to do is exactly wrong. So I have historically done better by selling my losers and using those to buy more of my winners, which is very mentally challenging to do. Because if you bought a stock at 10 and now it's at 30, it's really hard to put new money in that company at 30,
Right.
even if that is the smarter thing to do. And when I look back at some of the best investments that I've made, many times they were adding to stocks that were already up huge for me, and those winners went on to keep on winning. Having said that, I do think there are a couple of reasons when it's okay to sell, just to put them in a couple broad categories. Number one reason I sell is I was wrong. So I bought our stock for ABC reasons. They didn't pan out at all. And I was just flat out wrong about the analysis of the company. So if your thesis for a company changes, it's perfectly okay to say, I got that one wrong, and sell. Another reason is there can be emotional reasons when it can be a good time to sell. If you're losing sleep because a stock is up so much and it's become a big part of your portfolio, that is a really good reason to want to sell a stock. It has to pass, for me, the sleep well at night test. If I'm thinking about I have too much in one stock, it's not worth continuing to hold that, even if it goes up from there, because that would be affecting my life in a negative way. Another bucket of reasons that I sell are related to taxes. So sometimes there can be tax advantages to selling losers, right? You get to take that off of your adjusted income at tax time, or it can offset the gains of winners. And then my absolute favorite reason to sell, Brad, has to do with the reason I invested in the first place, which was I want to use that money to fund something in my everyday life. In 2017, I actually sold a big chunk of my stocks and we used that capital to pay off our house.
Oh, wow.
Financially speaking, that was stupid because the market is up substantially since 2017, and I was using it to pay off a very low interest rate. Emotionally, I would do it again in a heartbeat because now I don't have a mortgage to my name, and money is no longer automatically being sucked out of my checking account on the first of a month. And there's nothing that can happen to me that would cause me and my family to get kicked out of our house. So that to me is a great reason to sell when you want to use the money that you invested for your personal life. And this gets back to, Bill Perkins' whole die with zero thing, which has had a tremendous influence on my money psychology over the last couple of years. So your money and your investments are designed to give you a better life. So if giving you a better life includes selling to go on a vacation or buy something that you want or pay down debt, I personally believe that is a very good use of capital, irregardless of what the math says.
Hmm. Yeah, I like that. I think that's really important. And money is there to give you a better life. I mean, that's just a beautiful quote. And I also enjoy how you're so ultra conservative when it comes to personal finance, which is great, but yet you're somewhat aggressive, I think, when it comes to your investing life. And they both work together. You might not even conceptualize yourself as aggressive. Maybe I'm putting words in your mouth, but with high flying individual stocks and the likes of Tesla, et cetera, like they can work in tandem. And that, like, it actually affords you more opportunity to be so conservative in your personal life. Like you said, your mortgage is paid off. You and your wife are both still earning income. On some level, that can almost be, and I suspect very strongly, you are still saving money based on those incomes and your life expenses. So it's certainly more than a ChooseFI. But even if you wanted to just look at it as, hey, we're just bringing in exactly what our lives cost, all that significant net worth that you have, which probably almost by any definition puts you at traditional financial independence or FATFI, that's just compounding and growing in the background while you're covering your life expenses with your current income. I mean, Brian, that's about as close to bulletproof as you can come up with, right?
Let's hope, unless the market falls, 99% next time. Unless
Well,
Robert Kiyosaki is right, then I
yeah,
could be
yeah.
in a world of hurt. But yeah, absolutely. There are things that I could have done differently that would have resulted in a higher net worth. But if it would require more stress along the way or less life satisfaction along the way, that to me is a trade-off that I'm perfectly happy with.
Yeah, and that sleep well at night test, that's an important one. I mean, I use that in so many aspects of my life. It's just, it's not worth the dot, dot, dot. And it's essentially waking up in the middle of the night stressing about anything. Like I think about that in terms of just little aspects of my life that how can I cut this out? Because if one day a year, the annoyance of something is keeping me up at night or I'm stressing about it or there's some potential, it isn't worth it. It's just not worth it. So I think my entire operating system is stress mitigation. So I'm glad that you think similarly there. So you mentioned Bill Perkins and Die with Zero. So that's something that I mean from listening to ChooseFI that I've talked about dozens upon dozens of times on this podcast. People are probably almost sick and tired of hearing about it at this point. But I think it's just such an important rethink on how we look at the evolution of our financial lives, right? Because let's be clear, like our financial lives do evolve. And the place where you are now, where I am now, it's different than it was 10 years ago. It's different than it was 15 years ago before I had kids. And I think that's okay. That's part of the FI journey is it is going to evolve. It just is. And I'm curious how that book and that mindset, more importantly than the book, but the mindset has really impacted you in a nuts and bolts way.
The biggest thing that book did for me is it opened my eyes to the idea that there are certain seasons in our lives when we will do certain things. And it's really important to take advantage of the energy levels and the situation while it exists. Like, I personally have never been backpacking through Europe. I have many friends that did that when they were in college or right out of college. And backpacking through Europe sounds fun until I get to the whole I have to stay in hostels thing and live like a lifestyle like that. Not to mention the fact that I now have kids that are elementary/middle school age, and the logistics of that would just be extremely hard. So the opportunity to do that, to backpack through Europe, for me is effectively over. I could certainly visit Europe, but I wouldn't be backpacking through it for months, given what I have in life. And I look back on that now with a little tinge of regret that that is something that I had the opportunity to do, but did not do. So when I'm thinking about my life today, I'm in I'm 41 years old. I really want to take my kids to Japan at some point in our lives, and it's been something I've been thinking about for a couple of years. And when I've always thought, it's been like, oh yeah, that'll be something we do like in the way distant future.
Yeah.
But I'm now more thinking, nope, that's something I need to actually think about doing in the next like 2 to 3 years while they're at the right age for doing so. Even if financially it's extremely expensive for me to do so, and it'd be easier for me to do that financially 10 or 20 years from now. It's just the opportunity cost, to get back to that, of my kids are a certain age. It's the right time to do that. And I really want to pull forward many of those experiences that I want to have with them, even if it's more money than I would normally spend to do so, because there's just a certain season in my life that is a time to do that. So that was the real big thing that book did for me. It completely shifted the idea of saving the big experiences for quote unquote retirement, but I have far less energy than I do today.
Yeah, I like that. Seasons of life. I think that is important. And that was also what I was alluding to at the outset of even asking you about Divazir, right? Is like there's seasons of life, there's seasons of FI, there's seasons of every aspect of our life. And things are going to change. And yeah, like I could push back on your backpacking and say, like, well, yeah, you could still backpack. You don't have to stay at hostels. But the point is well taken that it's a very different trip than because I did that. So when I was 22, just graduated college, I went backpacking it was a short time. It was like 4 or 5 weeks with my brother. And yeah, we did the hostel thing and it was awesome. And those were memories that last a lifetime, right? But like, could I do that now at 44? Yeah, but I mean, I'm not going to want to, but I could still stay at hotels or something like that, and still get the essence of it. But it is a very different trip. So yeah, I mean, I think it's almost similar to like the Stoicism, the memento mori, which is remember death, which is some of these things sound kind of negative or morbid when you just on the face of them, which is like, hey, I'm going to die someday, or hey, my kids are going to grow up and be out of the house and not out of my life, but out of my day to day life. And while I think there's the initial quick hit thought of that is, wow, that's really sad. Like that's awful. I think what it actually does is say, man, I have to maximize this. I really need to hold on to every day. And I mean, Brian, no kidding. I have every day I open up Notepad I have just a PC. So Notepad opens and I have a countdown for the days until each of my daughters graduates high school. And I literally update it every single day. And it's like a very visceral way of seeing like, wow, this time is finite. Because you think about how fast a week goes, 7 days, 30 days, a month, like they just zip by. And I mean, this countdown is happening. And what it does for me is it says, I need to really enjoy this season with them because once they go to college, it's a very different season of life. So again, on the face of it, that might sound like a morbid thing, but it's not at all. It's really proven to be something very, very useful for me.
I love that. That is a great idea. I remember growing up, we had a countdown timer to the year 2000. That was like
Okay.
something that we just like had in the middle of the house to like see when the millennium was coming. It's a great idea to do that exact same thing, but for your kids graduating high school. I love it.
Yeah. So yeah, I do it in a very manual way. There's probably somebody's yelling at the screen saying, "Brad, you need to have some app on your desktop that has this." I'm sure there's. If you have it, send it in to me. Feedback@ChooseFI.com. I'd love to find that. But Brian, just going back, one thing you said in passing. So you were talking about Kiyosaki, and you're talking about ultimately like, do rich people think differently? And I think in a very positive way, like the millionaire next door, the FI millionaire next door does think very differently. And I think we've cataloged that. That's a wonderful thing. I think one aspect of investing that I find really vexing, let's say, or like people get caught up on is that there's some secret. There's some like investment behind the veil that when you get to $4 million net worth, like the club lets you in on, and it's unicorns and rainbows from here on out. Like I'm kind of setting this up in a silly way, but like, do you hear people talk about that and talk about like some secret investing or like hedge funds? Or I can vividly remember one of my coworkers who was a boss of mine talking about like it was like his life goal to invest in a hedge fund to be wealthy enough. And I'm like, Oh, wow. That's just like you just want affirmation. You don't actually want to be wealthy. Like this is just you want to tell your neighbor or the guy at the country club that you're investing in a hedge fund. That's solely what it was. Like I guess the short way of asking the question is like, what do you think when people say that? Because undoubtedly you've heard people talk about like, oh, well, rich people get access to this, or oh, when I'm that wealthy, I'll find out the secrets. Like, what do you think about that?
It's an understandable thing to have, especially since for years, the brokerage industry would only work with people once they had a certain amount of money. Like you literally couldn't open up a brokerage account with you. They would just completely ignore small people, to say nothing of the fact that brokerage costs used to be $50 a trade. So if you wanted to invest $100, it would be impossible because your $100 would get eaten up in just commissions, let alone anything else. So I think it's natural to have the initial mindset of, oh, once I reach fill in the blank, then all these magic opportunities open up to me. It's not entirely untrue because there are certain hedge funds, family funds, private equity, endowments, et cetera, that will only work with people that are above a certain net worth. There's also something called being an accredited investor. And that is a thing that you have to reach only when you have, I think the number was $1 million in investable assets or something
Yep.
along those lines. So it would be disingenuous to say, oh, there aren't these pretend things, these pretend milestones that you can get to that open up new investment opportunities to you. But personally, I have no interest in investing in any of that. I can't imagine changing that dramatically my investing style, no matter what my net worth is. I still want the vast majority of my wealth in the stock market. Perhaps I might have some more income coming from the stock market with like real estate investment trusts or master limit partnerships or just more focus on dividend income. But I personally have no interest in making any big changes as my net worth hits different milestones.
Yeah, same here. I've yet to be convinced that while you said there are these essentially like these little pretend clubs of like, okay, look, you get access to this. It doesn't mean you're going to get a better return by any means. And certainly net of fees. I think that's the biggest thing. Net of fees, the likelihood of it being better returns is slim to none, as evidenced by Warren Buffett's famous bet with the hedge fund managers, which is something that if you're hearing this, just Google that. It's kind of fun to
It was him
research.
versus Ted Seides. Yeah.
Yeah, and it was a 10 years net of fees, right? They could pick any hedge fund or fund of funds, and he basically just took the S&P 500, right? And needless to say, Mr. Buffett trounced them very handily. So,
Even though he started off in the hole, because I think
yeah,
it started in 2009 and the S&P 500 plunged in 2009 and the hedge funds didn't fall nearly as fast. And then the S&P 500 overtook it and never looked back. Yeah. So exactly your point. Any of those exotic investments, I don't understand what they would give me that the market already can't give me for dramatically lower cost and dramatically lower complexity.
yeah, agreed. And speaking of lower costs, so this is something I wanted to talk about on the podcast because I mentioned this in my newsletter a couple weeks ago. So for anybody who's not on my newsletter, choosefi.com/subscribe or just any page on the website in the upper right corner, you can get on the newsletter. And a lot of people, so obviously in the FI community, VTSAX has become almost like a meme on some levels in that like it's taken on a life of its own because obviously the wonderful JL Collins talks about it in the stock series and Simple Path to Wealth. And I think people now go out of their way to invest in VTSAX. And I think I'd love to set the record straight that essentially what you're looking to buy there is a total stock market, very low cost fund. But I think people again get caught up in the allure of Vanguard and VTSAX because they've heard about it so many times in the fight community. And I've seen people do this at, let's say, other brokerage firms. So they'll have, let's say, an account at Fidelity and they try to buy VTSAX. And now you can, Fidelity lets you, but I think they charge you a $75 fee every single time you purchase. So the long and the short of it, I don't want to waste a lot of time on this, but I have had a lot of people write me back saying, "Oh my goodness, I was doing this. You just saved me a whole lot of money. I didn't know I was spending." Like when you're at a different brokerage, in very broad general terms, you do not want to buy a mutual fund, the actual mutual fund of another brokerage. Okay. So that said, you can buy the ETF version at the other brokerage. And then it's just whatever the rules for commissions are, at that brokerage. So I think Vanguard, Fidelity, and Schwab, actually, according to our good buddy Frank Vasquez, who told me about this, they have $0 commissions on stock trades and ETFs at all of Vanguard, Fidelity, and Schwab. So in essence, if you were gung ho about buying a Vanguard total stock market fund, let's say, or ETF, you can just buy VTI. So if you have a Fidelity account or a Schwab account and you desperately want to get Vanguard, just buy VTI and there go the fees. So I actually had somebody, Brian, write into me saying they have a Fidelity HSA and they contribute, I think it was $150 monthly or twice a month, and they were buying VTSAX. So they got hit with a $75 fee every single time on a $150 transaction, literally 50% to fees. I think luckily it was happening in a short period of time, but them reading that newsletter was like, oh, wow, I didn't realize this. Let me just quickly switch. I mean, Fidelity has their own funds if you desperately want a mutual fund, or you could buy an ETF. So that's just something really important because when you come on, we think about the nuts and bolts of investing. And that was just something I've been really desperate to mention.
Yep. Great point. It's always important to know the costs involved with anything. So, like you said, even if you want to be in the club that owns VTSAX, just make sure that it's extremely low cost to get into that. Because if there's any cost involved, you're neutralizing the whole benefit of investing in the first place.
Exactly. Yeah. So, right. If you're at a different brokerage, don't buy anybody's mutual fund, just as a general back of the envelope rule. You can buy the ETF. In almost every case, it's virtually identical. So just keep that in mind and obviously do your own research. But that's how I think about this. All right. Well, Brian, thank you as always for coming on. I think this has been a fun just conversation, right? This is like a not a random walk down Wall Street, but a random chat about, hey, how are we thinking through the environment now? And I think it's important to just have these check-ins, just a bunch of nuggets of wisdom. So I really, really appreciate your time. I think this is going to be really valuable for people. So, okay, obviously people know that they can find you on Twitter. So you're at Brian Feroldi, and you are one of the most prolific people on Twitter. I think at last count, you have 530,000 followers, which is just truly remarkable. Where else can people find you these days?
Yep, I'm very active on Twitter or slash X
Yeah,
these
I
days.
refuse to
And
call it X,
yeah,
so
I
we're
do
we're
too.
going with Twitter
I do
here.
too. I'm also very active on LinkedIn if that's your jam. But I do want to let people know I just launched a free 5-day email-based course that just kind of goes over the basics of what the stock market is and how it works. If anybody's interested in that, the website there is just stockinvesting.school.
Ooh. Oh, I like that. Stockinvesting.school. So it's a .school
Yes,
website
.school.
address. That's neat.
Figured that would be a cool way to end it. Yeah.
Yeah, that's really cool. All right. So at Brian Feraldi on Twitter or stockinvesting.school. I like it. All right, Brian. As always, thank you, my friend. And we certainly will have you back in the very, very near future. Thanks again.
Thanks for having me, Brad. Always a pleasure to be here.